Us ball guides really need to understand cap rate.
So what cap rate is, it's a way to value a property based on the income that it produces. So it is mainly used for commercial buildings, but you can use it for residential buildings as well. We're going to explain what the cap rate is in this video. In this video, we're going to explain what the cap rate is simply and eloquently and motivationally as possible.
Yeah, so even cap rate is short for what is that? Capitalization rate? So
Correct.
It's usually expressed as a percentage, and we're going to teach you how to quickly figure out what the cap rate is for an investment opportunity.
So when I think about cap rate, I basically think it as your percent return. That's how you can think of it, as your percent return. So cap rates usually range in that 6% to 15% range. We're going to break down how you calculate that here that shortly. It's a pretty quick, easy calculation, but is using that 6% to 15% range. The higher the percentage, the riskier the deal, usually the worse area of town it is, and the higher percent your return is, the less risk is the lower cap rate. Like if your savings account is an extremely low percent return, but it's guaranteed. It's it's
for the
no
most
risk
part.
at all.
Yeah. Federally Reserve backed. You can use cap rates for a single family investment house, say a duplex, a 4-family, a 6-family, or a 500 unit apartment complex. Cap rate is a quick and easy way that's universally understood for all investors.
Yeah, I think of cap rates more on the multifamily, commercial, the bigger type buildings, because that is a way to get a value on a building based on the income it produces. Single families, you can use it as a benchmark, but a single family house is worth what the market says it is, what the comparables in the area. A single family house, there's usually several comparable houses in a very small area. A 400 unit, a 300 unit, you might have to go several miles before you find another comparable property that probably is in a different area. So that's, in my opinion, the main reason why cap rates were created, to help value buildings based on the income that they produced.
Yeah, so single family rentals, I feel like, have only become a real asset class maybe after the financial crisis of 2008. So definitely before that, it wasn't even heard of. Cap rates in single family rentals were never even mentioned in the same sentence. But nowadays, if you're talking about cap rates, you're probably talking about maybe like a portfolio or something of houses that you can sell based off a cap rate, probably to a hedge fund or out-of-town investors, or just investors with big pockets.
All right, so how do you figure out the cap rate? Figuring out what the cap rate is pretty simple, and you can take in different parts of the formula to figure it out, which we'll talk about here in a minute. But the basic formula is NOI divided by price equals cap rate, which is a percentage. NOI stands for net operating income divided by the price equals your percentage of cap rate. Does that make sense?
Yes.
All right, so how do you figure out NOI, Lucas?
Yeah, so net operating income is probably the main driver behind all of this. If you know that, you can figure out the other things. So let's talk about net operating income. So that's the gross rents that you're building, whether it's a single family rental, duplex, fourplex, or a 500 unit, is bringing in the gross rental income that asset is bringing in to your bank account every month. And that's, if you take that and you minus off, you subtract off your real estate taxes, your maintenance, your monthly maintenance, your property management fees, your vacancy. Did I say that yet?
Nope, you didn't.
What else we got?
Utilities, if you pay utilities, but basically your expenses besides your mortgage. Your mortgage is not included in your net operating income. Like I just did a video up here on how to figure out your cash flow on a single family property or multifamily property, what comes out of the cash flow, and your mortgage obviously comes out of that if you're talking about your net cash flow, but this is your net operating income, so your mortgage stays in your income for this calculation.
Correct.
What is cap rate, and how does understanding it make you a better investor? So after this video, you're going to have a good, clear understanding of what cap rate is, how to calculate it, and how it can help you buy better and understand deals better.
To start off understanding capitalization rate, you have to know the formula. So cap rate equals net operating income divided by the price or the value of the building.
So if you know two of these three variables of input, you can calculate the missing one. So we're going to talk about the formula, but before we do that, we're going to run some numbers and give a real life example. Let's talk about what you use cap rate for, and then we'll talk about what goes into the variables. So cap rate is used to put value on a building based on the income that it produces. In my opinion, cap rate should only be used for multifamily properties because it is basing the value of the building on how much income it produces. Single family houses, people these days tend to use cap rates more, or at least use as a reference point for their single family house. But If a single family house goes down in value a lot because the market dips, then the cap rate gets all screwed up, and a multifamily property is not going to drop in value as much because it's based on income, if that makes sense. A single family house value is based on what other single family houses have sold within a half a mile. Multifamilies, big multifamilies, there's usually not a ton within a half a mile, so they're using income to say how much it's worth.
Yeah, so especially because single family houses, they get traded, right? They get bought and sold, and it's mainly between, owner occupant to owner occupant. Probably, I don't even know the percentage, but a very high percentage, that's what the trading is in between. Through multifamilies, the trading's in between investors usually, so investors understand percentages. So you gotta have that percentage and know right away if it's a good deal. If you know if you know a multifamily building is generating an 8% cap in certain area, you'll know right away if that's a good deal for you.
Exactly, so let's break out the formula, and then we'll talk about what a higher percentage means and what's a lower percentage means, and where you'd want to be if you're in a certain area or certain area of town. So what goes into the net operating income, the very first part of the formula?
Yeah, I think that's the most important part of the formula to me. So the net operating income of a building or an investment property is your gross rents that you're bringing in minus all your expenses, except do not include your mortgage in this calculation.
Yeah, so there's a ton of expenses. We're not going to go get into all of them because some buildings have HOA you have to pay, certain taxes are different in certain areas, so we're not going to go in. But basically your expenses, your property taxes, your insurance, your maintenance, your vacancy, all that kind of stuff, all the expenses come out except your mortgage. That's the different part of this, is your net operating income, your mortgage, if you have a mortgage, stays in as income. It doesn't come out and drop your income even less. Like when you calculate cash flow, your mortgage comes out, obviously, because you have to pay that every month. But in this specific calculation, your mortgage stays in the formula.
Beautiful. So now that we know how to get the net operating income, the lower the cap rate percentage, and cap rate is expressed as a percentage, is the better area of town, and the higher cap rate percentage is the not so great area of town, or your more risky type of investments. So
yeah, so for a quick example, so if you have a really good area of town and you own a Walgreens, that's going to be extremely low cap rate because it's a great tenant, it's a good area of town.
Almost a guaranteed return.
Yeah, so that's going to be like a 4% cap rate. Yeah. But if you're in like a war zone or an area that has a bunch of crime, that's not a very good area.
With own a multifamily building.
Multifamily in that area of town, that's probably going to be more like a 12 to 15%. So that's kind of the general range, is usually for residential multifamily properties, usually that's 6 to 12, but if you bring commercial in, they usually go a little bit lower than the 6, and then if it's a rougher area, you can get up to 15. But the usual range is 6 to 12%, 6% being a great area of town, but you're not making as much on your money, and a 12% is a little rough area of town, but you're making more on your money because the risk is more, so you're getting a bigger return.
Beautiful. So now that we know the net operating income and the cap rate for our area, let's say we have an area of town that we love to invest in when the cap rate is 10% for multifamily buildings in this area. So now that we know the net operating income and say our 10% cap rate, we can figure out the value of that building.
Let's say a building produces $100,000 a year in net operating income, and it's in an area that's an okay area, it's a 10 cap. What's that building worth?
That building is worth $1 million.
So simple math there. So let's say...
and we got to that just by taking your net operating income and dividing it by your cap rate.
So pretty simple math. So if it's in a little nicer area of town,
say an 8% cap.
Say an 8% cap rate, use that exact same formula we just used. What's a building worth?
Yeah, so you would do your $100,000 net operating income divided by 0.08, which is 8%, and that gives you a value of the building of $1.25 million. So worth a lot more in the nicer area of town, $250,000 more than it would be in the 10% cap area of town. So how can you as an investor look at this and figure out if you're getting a good deal? So how we look at it is, so we know when we get financials of investment properties that are being marketed toward us, so we would know that net operating income. Obviously do your own due diligence to verify that, but and then we know the area of town. So if we know it's a 10% cap rate part of town, and so we know the building's probably worth $1 million based on our $100,000 NOI. So if he's marketing that building at $799,000, we know that's a deal, and we know we can go pay asking for that place. But if he's marketing at $1.29 million, we know we got to get under that that $1 million value to be able to get a good deal for us.
It's just a quick way to evaluate what something's worth. a multifamily or commercial building. You can do single families, but like I said, I'm not a huge fan of that. It's a quick way to evaluate that so you don't have to waste your time. You know, if you're really going to evaluate a multifamily building, it takes days. So you can do this quick numbers to see if it's worth what you think it's going to be worth, to see if it's worth putting more time and effort into it.
Yeah, let's do some quick numbers. So same type of scenario here. So you know the NOI, the net operating income, is 100 grand a year. And say someone's asking 1.25 million for that. So 100 grand a year divided by that 1.25 million is an 8% cap, right? We just talked about that. So if this building is in an 8% cap or higher, that's not a deal.
Okay.
And if that building is at 8% cap or lower, that could possibly be a deal for you guys. So,
yeah. So that makes a ton of sense. So if you don't know your cap rate of your area, you can use the other two variables to find out what your cap rate percentage is. If you don't exactly know, right?
No, because you just get the cap rate of what they're asking.
Okay.
So you need to do some research on what the cap rate is in the area.
In order to make this formula make sense, you do need to know your areas. You need to know if it's a 6 cap rate area or a 12 cap rate area. So you can do that by talking to other investors that invest in the area, and you just a quick, simple, you know, a really good area, like we said, is a 6 rate, and a pretty rough area is a 12. So you're gonna have to use your judgment on where it falls in between.
Yeah, and do some online research about cap rates, and maybe ask some other investors in your area what they run their cap rates at a certain part of town. So, and also remember that there's different cap rates for different asset classes. So a cap rate for a storage facility, say, will be a lot different than a multifamily building. So the most important part to us, what matters to us as investors, is cash flow.
I like that cash.
I like it, a cap rate and a cash flow. So, and how does that come into play when you know your NOI and your cap rate? So as an investor, most of us do not put 100% cash to buy a building.
I wouldn't even suggest doing that.
No, even if you had it. So all of us have some sort of financing in place to take down a $1 million building that we were talking about. So in order to take that down, you're gonna have, after you take it down, you're gonna have a monthly mortgage payment. So what you gotta do is you gotta take that mortgage payment and subtract it off your NOI, and then that'll get you your actual true cash flow. And the cap rate is just a barometer on what type of, on if that investment is a good deal, because everybody has different type of financing, right? Whether you're buying cash, putting 20% down, using the BRRRR method, amortizing over 20 years, amortizing over 30 years, 4% versus 5%. So
some people do 1031 tax exchange, put 50% down.
Exactly. So make sure you get that net operating income and you take your financing and subtract off that and make sure it's still cash flows for you. And the lower the cap rate, the more trouble you're going to have to get that to cash flow with financing in place.
Okay, so we just covered the cap rate earlier and all the 3 variables that go into creating that and calculating it. That's a very simple formula with several nuanced pieces that go into each variable. And then Lucas really drove home there at the end the fact that you do need to make sure you know what your cash flow is going to be at the end after your mortgage, because everybody's mortgage is different. So hopefully that helped you understand cap rate a little bit more. It's a pretty simple formula. Just watch this video a couple times because there's a lot of moving parts going on, and do your research online and just pencil this out a few times. Once you pencil a few out, like we did a few examples, but do 5 or 10 of those, you really will start to understand it. And understanding cap rate is really, really good when it comes to investing and just understanding being to evaluate properties quickly.
So use this video, use this formula, and go out and buy your first multifamily deal.
Awesome. Subscribe to this channel, like and comment. Please comment on this video. We'd appreciate it. All right, so we are going to. Hey! Oh goodness, Gracie, that scare you, Yates?
That's what you were like.
Girls.
They yell at you a lot?
Like with that low of tone?
Is that low?
All right, so what is cap rate and how can you better understand it and make... So what is cap rate and how can you understand it to better understand how to invest in properties? What is wrong with that?
So what is cap rate and how is
No, we're saying it just a little weird. Gosh darn it. So what is cap rate and how can you as an investor?
How does understanding it help you?
Yes.
What is cap rate? So what we're going to talk about is what we're going to talk about. I'm trying to think of. So what is, all right.
Inputs, variables? Which one? Variables?
Variables.
Wait, this is bad.
Yeah. All right, well, hope this helped explain cap rate a little better. It's a little bit of...
amortizing, I hate that word, amortizing over, is that it? Amortizing, amortizing.
All right, we all have shit to do.